Have you ever felt lost when people talk about business finance? Words like revenue, assets, or ROI sound heavy, right? Many business owners and entrepreneurs nod their heads in meetings, but secretly wonder, what does that really mean? The confusion is normal. Finance sounds like something only experts can understand. But here's the good news. In this video, you will learn 20 basic components of business finance that can help you grow your business financially. Number 1. Revenue. Revenue is the total money a business earns from selling its products or services before cutting any costs. Think of it as your salary before paying rent, bills, or groceries. For example, if a bakery sells 1,000 cupcakes at $2 each, the revenue is $2,000. Revenue is important because it shows how much money is coming in. Without revenue, a business cannot survive. Every company looks for ways to increase revenue by selling more, raising prices, or finding new customers. It is the first line in any financial statement. Number 2. Profit. Profit is what's left after subtracting all costs from revenue. It's like your pocket money after paying all household expenses. For example, if your bakery earns $2,000 in revenue and spends $1,500 on ingredients, rent, and salaries, then profit is $500. Businesses need profit to grow, pay shareholders, and reinvest in the company. A company may have high revenue, but still fail if costs are too high. That's why profit is often called the bottom line. It is the main indicator of financial health. Number 3. Cash flow. Cash flow means the movement of money in and out of a business. Imagine your personal bank account. Salary comes in and bills go out. If more money leaves than enters, you have a problem. For example, if your bakery earns $2,000 this month, but has $2,500 in expenses, your cash flow is negative. A business may look profitable on paper, but still struggle if cash flow is poor. Managing cash flow ensures that bills, salaries, and suppliers are paid on time. Number 4. Assets. Assets are things a business owns that have value. They can be physical, like buildings, machines, or cars, or non-physical, like patents and brand reputation. For example, a bakery's oven, shop building, and delivery van are assets. Even money in the bank is an asset. Assets help a business generate income. Owning strong assets means the business has a foundation to grow and operate smoothly. Investors often check a company's assets before making decisions. Number 5. Liabilities. Liabilities are the opposite of assets. They are what the business owes to others. Think of loans, unpaid bills, or credit card balances. For example, if your bakery borrowed $5,000 from a bank, that loan is a liability. Liabilities must be managed carefully because too much debt can sink a business. However, not all liabilities are bad. Some loans help companies expand and earn more in the future. The key is balance between assets and liabilities. Number 6. Equity. Equity is the value that remains for the owner after subtracting liabilities from assets. It is sometimes called owner's wealth. For example, if your bakery has $50,000 in assets like business building, oven, cash, and $20,000 in liabilities like loans, then your equity is $30,000. Investors care about equity because it shows how much value the owners hold in the business. Positive equity is a sign of stability. Negative equity signals trouble and can scare investors away. Number 7. ROI, return on investment. ROI measures how much money you earn compared to how much you invested. It's like putting $100 in and getting $120 back. For example, if your bakery spends $1,000 on marketing and earns $2,000 more in sales, ROI is 100%. ROI helps decide if an investment was worth it. Businesses use ROI to measure everything from ads to machinery. A high ROI means money is used wisely. Low ROI means the strategy needs change. Number 8. Break-even point. Break-even is when your total revenue equals your total costs. At this point, you are not making profit, but not losing money either. For example, if your bakery spends $500 on ingredients and $500 on rent, you need $1,000 in sales to break even. Anything you earn beyond this is profit. The break-even point is important for planning because it tells you how much you need to sell just to survive. Number 9, gross margin. Gross margin is the money left after subtracting the cost of goods sold from revenue. It's like knowing how much you earn from selling cupcakes after only subtracting the ingredient costs, but before rent or salaries. For example, if a cupcake sells for $2 and costs $1 in ingredients, gross margin is $1. Higher gross margins mean more money to cover other expenses and profit. It shows how efficiently you produce and sell. Number 10, net margin. Net margin is profit after subtracting all costs, including rent, salaries, and taxes from revenue. It tells you how much money truly stays in your pocket. For example, if your bakery earns $2,000 in revenue, spends $1,700 in costs, and pays $100 in taxes, then net profit is $200. Net margin is calculated as net profit divided by revenue. A higher net margin means a business runs more efficiently. Number 11, working capital. Working capital is the difference between current assets and current liabilities. It shows how much short-term money you have to run your business. For example, if your bakery has $10,000 in cash and inventory, but owes $7,000 in short-term bills, your working capital is $3,000. Positive working capital means you can easily pay bills. Negative working capital shows trouble and may lead to borrowing money. Number 12, accounts receivable. Accounts receivable is money your customers owe you. For example, if you supply 100 cakes to a hotel worth $5,000 but they promise to pay in 30 days, that $5,000 is accounts receivable. It is an asset but can become risky if customers delay or don't pay. Businesses try to collect receivables quickly because money stuck here cannot be used for daily expenses. Number 13, accounts payable. Accounts payable is money you owe to your suppliers. For example, if your bakery buys flour and sugar worth $2,000 on credit and you promise to pay in 30 days, that $2,000 is accounts payable. It is a liability. Managing accounts payable wisely means paying on time, but also using credit periods smartly to keep more cash in hand. Number 14, depreciation. Depreciation means the decrease in value of assets over time. For example, when you buy a bakery oven for $10,000, it loses value every year because of use and wear. After 5 years, it may only be worth $3,000. Businesses record depreciation in accounts to reflect the real value of assets. It also reduces taxable income, which is helpful for managing taxes. Number 15, budgeting. Budgeting is the process of planning how to spend money. It's like planning your monthly salary for rent, food, and savings. For example, a bakery may set aside $500 for marketing, $1,000 for ingredients, and $700 for salaries. Budgeting helps control overspending and ensures money is used wisely. Without budgeting, businesses often face cash shortages. Number 16, forecasting. Forecasting is predicting future financial outcomes based on past data. For example, if your bakery sold 1,000 cupcakes every December for the last 3 years, you can forecast that this December sales will be similar or higher. Forecasting helps in planning inventory, staff, and expenses. Accurate forecasting saves businesses from surprises and prepares them for opportunities. Number 17, capital expenditure. Capital expenditure is money spent to buy or upgrade long-term assets like machines, buildings, or technology. For example, buying a new oven for $5,000 is capital expenditure because it will help the bakery for years. It is different from daily expenses like rent or ingredients. Businesses need capital expenditure to grow and modernize. However, too much capital expenditure without proper planning can hurt cash flow. Number 18, operating expenses. Operating expenses are the costs of running a business daily. For example, rent, salaries, electricity, and advertising are operating expenses. If your bakery spends $700 monthly on salaries and $300 on electricity, that's operating expenses. Keeping operating expenses low helps increase profits. However, cutting too much may also hurt quality. Smart businesses balance operating expenses for growth. Number 19, interest. Interest is the extra money you pay when you borrow or earn when you lend. For example, if you borrow $1,000 at 10% yearly interest, you pay back $1,100. Similarly, if you deposit $1,000 in a bank at 5% interest, you earn $50 in a year. Businesses monitor interest carefully because high interest payments reduce profits. Number 20. Taxation. Taxation is the money businesses pay to the government on their income. For example, if your bakery makes $10,000 profit and the tax rate is 20%, you pay $2,000 in taxes. Taxes are mandatory, and failing to pay brings penalties. Smart businesses plan taxes using legal strategies to save money and increase profits. Now you understand 20 important business finance components. These basics will help you read financial reports, make better decisions, and talk confidently in business discussions. Keep learning, keep practicing, and finance will never feel confusing again. Thanks for watching, and see you soon.